My name is Saskia Slomp. I hope you're all well and healthy. I wish you a warm welcome today to our webinar on PFS, especially to the speakers, but also to all the people in the audience. So this is our second webinar that we have on primary financial statements. Last week we had one with a Danish focus, with Danish preparers, and not only a Danish audience. And today and next week we have a user focus. This is clearly demonstrated by the speakers we have. You've seen we have Nick Anderson, IASB board member with a user background. We have Hans Buysse, our board member with a user background. And we have an eminent panel of users, Marietta, Miemietz, Stefaan, Genoe, and Peter Malmqvist. And the takeaways will be presented by Serge Pattyn, and he is a former EFRAG member with a user background. So you can see the user input is guaranteed today. Originally, we had hoped that this would be a physical meeting once we scheduled it, but of course, like everywhere else, because of the crisis, we had to turn it into a webinar. Actually, we have turned it into 2 webinars. So one today and one, the next meeting is, our next meeting is next week's, same day, same time, same speakers. So if you like it, we hope to see you all again next week. Today, we focus on the presentation requirements, on the income statement and the statement of cash flows. And next week, the focus will be on disclosure requirements. And that will include then discussions on management performance measures and unusual items. As I said, so we hope to see you again next week. You can ask questions today to all these eminent users if you want. By this Slido app, you have received a message through our system that links you to our website where the instructions are there. And there you find as well the bios and the photos of the presenters and the slides. So I will not introduce all the speakers one by one because you can look yourself in this on the website to their bios. So we will go immediately to the presentation. We have 75 minutes, which sounds perhaps long, but from last week's experience, it's relatively short. So I think for you now to listen to the speakers, I'm handing over to the IASB, who is first going to present our exposure draft, the relevant parts for the discussions of today. And we have Nick and we have Aida, and Aida is leading the IASB primary financial statements team. So I don't know who starts, Nick or Aida, but over to the IASB.
Thanks, Saskia. It's Nick, and good afternoon, everyone. Just to remind you to begin with, the board's project on primary financial statements is in direct response to requests from the users of financial statements for improvements, particularly in performance reporting. And although these requests have been long-standing, there is a logic to the board having first focused on measurement and recognition and then moving to presentation and related disclosures. In this project, we're looking at improving communication throughout the financial statements, but with a specific focus on the P&L statement. Personally, I'm pleased with the initial feedback that we've heard. It's been very constructive, but we're still in listening mode today. And so first, Aida and I will summarize the board's main proposals. So the slide that you see now shows the project and the main proposals. These have been directly driven by the users of financial statements. Right at the start of the project, we did some extensive outreach with investors and other users to identify the key issues and determine the project scope. And the common themes became quite clear quite quickly. These are shown on the left-hand column of this slide. The slide shows that the main 3 set of proposals with some additional proposals around cash flow, and those proposals are shown in the center column with expected benefits to users on the right-hand side. So just to run through those briefly. Users told us that the structure and the content of the statement of financial performance varies between entities, even within the same industry, and that this makes it difficult for investors to assess and compare financial performance between companies. Investors want more comparability, and that's particularly in a world where investment portfolios are managed increasingly on an international, if not a global basis. So to address this concern, the board proposes to require defined subtotals in the statement of profit or loss. Secondly, investors have been telling us that they sometimes do not get sufficiently granular information in the financial statements. So in response to this, the board is proposing to strengthen requirements for disaggregating information in the statements. And the third topic is about those non-GAAP measures, which the board has called management-defined performance measures. Investors have told us that these measures are useful to their analysis. They're certainly prevalent in the market. However, they feel that the information presented in these measures should be more transparent and presented in a more disciplined way, and indeed more easy to access. So in the response, the board has defined a subset of non-GAAP measures, as I say, which we call management performance measures, and these require disclosures about them in the notes to the financial statements. So I could just have the next slide, please. So just to remind you, as Saskia said, the focus of our discussion today is on the P&L statement, a new structure for the P&L statement, the analysis of operating expenses, and focused improvements to the statement of cash flows. We'll be discussing the remaining topics at the same time next week. And with that, let me pass over to Aida.
Thank you very much, Nick, and good afternoon, everyone. So let's dive into the proposed facelift of the income statement. And just to be clear, not the facelift of the presenters today, some of whom you see. So let's look at the slide 7. So here, this slide illustrates proposals for subtotals and categories in the statement of profit or loss. And what the board is proposing is to require all entities to classify income and expenses in 4 categories in the statement of profit or loss, and 3 subtotals between these categories. And you can see categories in the boxes on the right-hand side, and subtotals are highlighted in between. So this illustration shows us a possible presentation, but I just want to note that not all line items that you see in this presentation would be required line items. Also, this example is meant to illustrate how proposals would work for most companies, but in a minute I will come to how they will work for financial entities, for example, banks or insurers. So let's start with operating profit and operating category. So operating profit is very commonly used subtotal today. Actually, it's so common that when we speak to users of financial statements, some of them tell us that they think it's already defined. But as you all know, it's not a defined subtotal, and we find companies use many different definitions in practice. So what the board's objective of the operating category is to make sure that includes all income and expenses from entities' main business activities. However, this category is defined as a default category, which means that all income and expenses that do not meet definitions of one of the other categories would by default be classified as operating. And the board thought this approach would really work well to achieve consistent classification of what goes into the operating category. And also it thought that this approach was consistent with the view that by default entities' activities are operating. So let's move on from operating category. Let's look at further down at the bottom at the financing category. So we see before financing category, we have a subtotal. One of the new subtotals, profit before financing and income taxes. So the objective of this subtotal is to enable users to compare performance of entities regardless of how they are financed. And as you might expect, this category would include things like interest on loans. So this would be presented within the line item that you see labeled expenses from financing activities. But this category would also include interest on non-financial liabilities. So, for example, unwinding of discount on pensions or provisions that you can see here on the slide. But it would also include all interest, income and expenses on cash and cash equivalents, which you don't see illustrated in this example here. So let's now go up. Let's look at the investing category. So the objective of the investing category is to enable users to separately analyze returns from assets that arise quite independently from entities' main business activities. So for general corporate, things that you would find here are returns on their financial instruments or their investment properties. So these are three main new categories, and we have left with integral associates and joint ventures. And this category came about as a result of the board balancing the needs of users who said that they do not want any share of profit or loss from equity accounted investments in the operating category because it would, for example, mess up their margin analysis. But on the other hand, preparers have asked to be able to present results of associates and joint ventures that are closely related to their main business activities as close to operating as possible, if not within. So this proposal is, the proposal is essentially for entities to identify which associate and joint ventures are closely related, in other words, integral to their main business activities, and present results from those separately and straight after operating profit, increasing their prominence. And therefore, we have this third subtotal here in the middle. And then share of profit from all other associate and joint ventures would meet definition of income and expenses from investments and would be classified in the investing category. So this was a quick look of the what we call general model, but in the board's deliberations it became clear that this would not work well for all companies. So for example, if a bank was to apply what is on this slide here, it would mean that it would present their interest expense in the financing category and would not be able to present net interest income in the operating profit, which is their key performance indicator. So what the board has done is identified some principles based on business activities for when companies such as banks would be required to move items up from investing and or financing categories into operating. And these principles capture companies that either provide financing to customers as their main business activity or invest in the course of their main business activities. And as a part of these proposals, some companies would also be exempt from presenting profit before financing and income tax subtotal, and this is illustrated on the slide that you see now. So just as a reminder, again, this slide shows illustration of possible presentation and does not mean that the line items that you see here would all be required line items. And what this slide shows is an example of a bank that provides loans to customers and invests in financial assets as a main business activity, and they move interest expense, you can see it in green here, they move it up from the financing into operating, and they also move investment and trading income from investing, and it becomes part of operating profit. In general, the expectation is that presentation for financial entities such as these would really be quite similar to what they do in practice today. So this was a summary of our proposals on subtotals and categories, and I will now hand back to Nick to go through the rest of the proposals relating to presentation.
Thanks, Aida. Could I have the next slide, please? So the board is also proposing to strengthen requirements on the presentation of operating expenses. Just to remind you, there are two ways for a company to break down operating expenses. One is by nature, where the expenses are broken down by the type of input. So it may be your employee expenses, employee or your depreciation. And the other way is by function, which means expenses are allocated to functions such as cost of sales or SG&A. What the board is proposing is two things. First of all, on the face of the income statement, to clarify that entities should present either by nature or by function. This isn't a free choice. Companies would need to look at a set of indicators to determine which presentation is the most useful presentation. Other than the circumstances when a company presents by function but is also required to present one or more minimum line items, a presentation that mixes by nature and by function is not permitted. And investors have highlighted specific examples of mixed presentation which they do not find helpful. Secondly, the board have also been told by investors that they need complete information about expenses by nature for all companies, because it's easier to forecast than expenses by function, and there's a closer relationship to the cash flow statement. So the board is proposing that companies that present by function on the face are also required to disclose total operating expenses disaggregated by nature in the notes. We're cognizant that many companies are telling us that this would be costly to do, and we'll consider that when we redeliberate our proposals. And then if I could have the final slide here, please, or the next slide rather, turning to the statement of cash flow. Here, the board's intending to make some limited to tactical improvements to the statement of cash flow. It's not a comprehensive review, and I suspect we will come back to doing further work on the statement of cash flows, and we look forward to what our stakeholders tell us in the forthcoming agenda consultation. But there are two main improvements. First of all, for entities that provide an indirect reconciliation, the consistent starting point for the cash flow statement will be operating profit. Operating profit is now defined by the board. I think users have asked for many years for a consistent starting point that is high up the income statement. And secondly, the board is proposing to remove a number of classification options around dividends and interest. So for instance, today, dividends received, which could be from equity investments, may appear either in operating or investing, and the board is proposing for the vast majority of entities, they will always be found in investing going forward. If I could just have the last slide, please. Just a reminder that we published our proposals in an exposure draft in December of last year. And if these are finalized, they will replace IS1, the statement on presentation of financial statements. The exposure draft is currently out for comment, and the board last month agreed to extend the comment letter deadline period to the end of September, just given current conditions, allowing our stakeholders a little more time to respond. So I will leave it there and say thank you very much.
Thank you, Nick and Aida, for introducing us again to the exposure draft and refreshing our memory. Before I hand over to Chiara, I want to remind the audience that we would like them to do one poll question so that actually we have a bit of insight how many users, how many preparers are in the background of the people that are listening. So if you can just do that one poll. We are not showing it, it's for our background. I'm now handing over to Chiara, who is our EFRAG Tech Chairwoman, Chiara del Prete, and she's going to give the EFRAG views on the various issues. Chiara?
Thank you, Saskia. Good afternoon, everyone. So can I have the slides projected on the screen, please? First of all, on our due process, we issued a draft comments letter on the 24th of February, where we presented our views, and these views are still open at discussion, and we would really welcome the input from all the European stakeholders from the various categories. Our letter is open for comment until the 28th of September 2020. To anticipate the expect of these proposals, we ran early stages whose results are also included in our draft comments letter as a support for the constituents to understand the implications in practice of the IASB's proposals. In our letter, we welcome the project and the proposals, the detailed proposals by the IASB. And as Nick said, there and as Nick said, these. I just wanted to check if you hear me well, or shall I switch to the phone connection? Is that okay?
It's okay. It's not perfect, but it's okay.
Okay. So I was saying we strongly support the proposals and the letter because it responds to a long-lasting demand from the users to improve the structure of the financial statements. As part of our outreach, we are also reaching out to preparers, and we welcome further candidatures for our field test by the 21st of July, done in cooperation with the IASB and national standard setters. Can we go to the next slides, please? So going into the detail of the proposals illustrated by Aida and Nick, we support the introduction of the three proposed categories, financing, investing, and operating, because they will improve the comparability and reduce the diversity in practice. Also, our stage analysis, our other similar studies, confirmed that the operating result or operating earning is widely used, almost universally. So we expect that these amendments, these proposals will have broad impacts, because the extent that the operating has been used so far, the entities will be required to assess to what extent they were using principles consistent with these new proposals. So it will be important to understand how these are changing. Of course, in practice, the concept of the entity's main business activity needs to be tested, because it has a component of residual and a component of positive definition, as was illustrated before. So it will be important to understand how it works in practice. We also note in our letter that these requirements of presentation will interact with also local regulatory frameworks, not only segment like for banks or for insurance, but also in some European jurisdictions there are detailed presentation requirements for other sectors. So we will have to see how this will work in practice. Can we go to the next slide, please? So during our discussions, there was a wide support and a clear understanding of what was operating, but several discussions have been done on how to split further what is financing from what is operating, because this has been so far very much entity specific. So we have now new concepts, and these concepts have to be tested compared to how the entities so far interpreted these two elements. And we haven't yet taken a position on whether the items of income and expenses coming from cash and cash equivalent and the time value of money should be included in the financing category IASB is suggesting. Because our views, the views in our tech were split, so we welcome views from the constituents and also from users, of course, on whether we should support these proposals. Then we have also included some remarks on how these proposals will operate in practice for conglomerates, that is for entities that operate as main business activities several different operating segments. So how the different subtotals would fit into one only presentation of statement of profit or loss. For financial institutions, insurance and banks, where the financing and the investing will be included in the operating category, we support, of course, this proposal because this is consistent with what is done by entities. We raise questions whether on the choice that the IASB has allowed for a manufacturer that provides also financing to customers, not to present a separate financing category, because we think this option is only relevant when providing financing to customers is the dominating activity. In terms of integral and non-integral associates, we welcome this proposal because this is also addressing a key relevant area of diversity in practice. But also in this case, we are curious to test, of course, how it will work in practice, because it entails very much judgment, significant amount of judgment. and can also for example, governance compared to how today entities are organized. Can we go to the next slide, please? For the analysis of operating expenses, we understand that for European users it's particularly important to have the split by nature, and we support the IASB proposals. However, in the details of our discussion, we were uncertain on the meaning behind requiring the presentation by nature when the entity concludes that the most representative approach is by function. So we are seeking specific views on this proposal by the IASB. We also note that in the exposure draft, there is an element of mixture between by nature and the function, because as part of the minimum light item, there are items like the cost of sales and the impairment, which in case of adoption of by function will result in some sort of mix. And we have also heard from some jurisdictions that they would like to prefer a mixed presentation. So we seek specific views on this point before concluding. I don't know if this was the last one or if we have another slide. Yes. Aggregation and disaggregation, we also support the proposal to have more clear role for the primary statements and the notes. On the EBIT and EBITDA, we regret that they have not been defined because they are widely used, and at the same time we question why they do not qualify to be a management performance measure. On other comprehensive income and other standards, we also include some suggestions to the IASB because, for example, for the other comprehensive income, the changes that are proposed are only minor. They are basically renaming some items, while we would have appreciated a more broad discussion on the role of OCI, including also the recycling. For the future, we also consider that the IASB should work on other improvements of the statement of changes in equity, changes in cash flow, the statement of cash flows and of financial position. For example, the definition of debt is not provided, and this is a key metric for the users. Can we go to the next slide? Few words on the statement of cash flows, and this is the last one.
Yeah, it's the last one.
We note that the IASB has used a similar labeling for the categories in the cash flow statement and in the statement of profit or loss, but details of the items are not aligned between the two statements. And we think this will create confusion, suggest to change the labels to be more clear, unless the IASB or until the IASB will undertake a broader project on cash flow statements, something that we strongly suggest, as also Nick was anticipating before. So I think this is all from my side, right?
Yes, thank you, Chiara.
To Hans.
Yeah. So thank you, Chiara. So Hans, up to you. We noticed that there are already a few questions, but we will first start with a panel discussion, and Hans is going to introduce his panelists very briefly. As I said, we have the bios on the website, and we will spend most of the time on discussing with them. Hans, over to you.
So I will not go into detail on the bios since they are on the website, but I would, in case of time, because I see we are already 5:30, if you agree, to start immediately with the first question. Is that a good idea? I see nodding everywhere. So let's first start with the first part. Can you all hear me, please?
Yes.
Yes, I can hear you, Peter, here.
Yeah. I will give you a combined question. So the exposure draft that was just seen introduces an operating, an investing, and a financing section in the income statement. And as we heard, we wanted that because new categories would improve comparability and reduce diversity in practice. And if you listen to users, responding to the users' demand of separating investments and main business activities from others is what they wanted. But the question that I would like to address, people of the panel, I'll be careful, it's a number of questions here is, do you agree with this approach of splitting it between the operating, investing, and the financing section? What is the added value for users, you think? Subtotals, such as profit or loss before financing and income tax, although similar to EBIT, depend on the definition of the financing category. But here I have a question as well. Do you agree with operating profit as a new predefined subtotal, or would another subtotal such as EBIT or EBITDA be more useful? And the last question that I have in this category is the new presentation really helpful for users when we look to performance evaluation? Peter, could I start with you as the first target on these three questions? What do you think on the value of splitting them? Do you agree that we use operating profit, or should it be EBIT or EBITDA? And is the new presentation for you as a user really helpful in performance evaluation?
Okay, a lot of questions. Hope you can hear me, everyone. In general, yes, yeah, I think it's useful to separate operating from what we today, at least in Europe, normally has as operating is good, because operating today is very often including earnings in associated companies, and that is kind of confusing. It's such a different number and compiled very differently compared to the subsidiaries. So I prefer to have operating earnings including only consolidated subsidiaries. So in that sense, I think it's a good suggestion. Going to the not so good, but I can live with it, is to separate integral from non-integral associates. I mean, you can label them if you like in the income statement, integral and non-integral. My guess, or more, I'm quite convinced that in Sweden, most associated companies are integral. Very few are non-integral, like equity investments as such. But I don't really see a need for this summarization of their integral associates. So in my view, it would be clearer if we had operating, investing, financing, and then tax. So I would not have this extra line included in the income statement saying kind of operating earnings, including integral associates. But if the companies want to, they can label an associated company integral or non-integral, but I don't see any need for the summarization. Do I want EBIT or EBITDA instead? I mean, EBIT, what we have now, profit before financing and income tax, is to me quite close to what the US called EBIT. So if we would label that part earnings before interest and taxes, that is to me the EBIT. Maybe we don't want that shortening. No big deal. I have the line, and I think it will be very much used, particularly when we present earnings in a company. So I think it will be used. EBITDA, well, then you need this operating expenses presented by nature. Otherwise, you mix the two. So EBITDA, I think, is in general a very confusing concept. So no, I would not prefer to have it presented including an EBITDA. Thank you.
Okay. Stefaan, you as a real analyst and a corporate finance professionals, what are your ideas on these three categories, on EBIT or EBITDA, but specifically also, is this new presentation really useful and for users and helpful for users in performance evaluation? Stefaan.
Yes, I think I agree that, of course, separating the different items, it makes us start from what we hope to be a cleaner basis, being the operating profit. And as an analyst, we know that's, if we look at that line, that's really related to the operating business. From that point of view, and then I jump to the last point immediately, I would certainly not use EBITDA as a base number, because in my view, EBITDA is a more manipulative number than operating profit, in a sense that you've got impact from amortization of certain cost, capitalization of costs, which will impact, etc. So then you have a much more difficult basis and difficult to analyze basis to start your analysis from. in regards to the associates and joint ventures, I'm not convinced about the separation of both, because now you might have people taking the integral associates and joint ventures as being part of business, and as such start using them, what I would say, as their base number being the operating profit, and they forget that these are two different items. And of course it are two totally different numbers. The operating profit is pre-tax, while the associates and joint ventures is a net earnings contribution, which you risk to imply in a gross number before tax and before interest charges. So I'm not convinced. So that's still a risk. So actually, I even tend to prefer the combination of both. In one segment of the P&L, also because I would value both of them similarly, in a sense that I will not apply the typical multiples to them as being part of the consolidated accounts, but I would value them separately apart from the multiples I would apply to the traditional ongoing operating business. So those are a bit my remarks on the different items. I don't know whether I forget one of them, but...
No, I don't think so. I'm checking the questions that we received already. Saskia, can I have a quick look at those? Because I see one question coming up. Will it still be possible to have other subtotals within the operating category, in particular with a presentation by function? I will leave that for the second questions. Presentations by functions. Is it proposed that share of profits from integral and non-integral associations or GVs is on a pre-tax basis? Also, is it integral to judgmental? Somebody wanted to take that one now, or are we going to put this with question 3 as well? I think we're going to wait a little bit for question 3 and then get back to those. Is that okay? Unless somebody wants to take the floor immediately right now.
Perhaps a little remark on the pre-tax for the integral associates, and with now the number being post-tax. Of course, I think there it's important to have probably some additional info on the activity, pre-tax and post-tax, because then you can start comparing it with your actual business. Also pre-tax, and that's very important because it's considered to be integral to the business. So if you could also have the details, for example, also pre-tax, I think that would add value, yes. Okay.
I will move to the second batch of questions. So we are all financial analysts or users, and what are the panel members as analysts' views about the approach to presenting results from the integral and non-integral associates and joint ventures? Will it be useful? Why or why not? Will it impact our analysis? And does it, as we want it to be, does it enhance comparability? Marietta, what are your views as a user on this one?
Well, I very much agree with what Peter was talking about earlier, or Stefaan. I'm concerned about the distinction between the integral and the non-integral JVs and associates. I would actually like to see them lumped together with separate disclosures then on each joint venture and associate in the notes. The distinction between integral and non-integral to me is highly subjective, and I fear also highly political, because calling a joint venture non-integral could actually lead to your joint venture partner really questioning your commitment. And generally, there's a lot of investor pressure on companies to stick with their core competencies and the areas where they can compete in the long term. So calling anything non-integral really invites a lot of investor scrutiny. And if something is not integral to your business, then why go there in the first place? I think you're going to get pressure to examine if you're actually the best owner of that business. So if I was a preparer, I'd always make that classification decision between integral and non-integral purely on my intention to retain or exit a business in the short or medium term. And I think that will actually lead to lots of reclassifications and lots of confusion. And analytically, the distinction really adds nothing. As an analyst, I'll have my own views about the operating and strategic and financial importance of each associate and joint venture. And I also wanted to, in this context, just quickly say a word on margins and margin structures and how we should be thinking about those. So I think the PFS project is very valuable in terms of creating more transparency around performance reporting and making absolute profit figures more comparable across companies. The separation between pre- and post-tax figures is also very important, and my colleagues have already touched on that. But at the same time, I think analysts really need to get rid of the widespread but hopelessly archaic idea that two companies that operate businesses of similar quality in the same industry are going to have similar margins and margin structures. It's just absolutely not true in a world of resource and risk sharing, which is what JVs and associates a lot of times are all about. And to properly analyze a company, we really need to buckle down and dissect all of the cash flow streams, not just multiply the sales through with some margin and throw random valuation multiples at the profits that gives us. So to me, there's really no point in calculating a pre-non-integral joint venture margin. So those would be my comments on that subject.
Okay. Peter, what is your point of view here?
Was it Peter you said? Yeah.
Yes. So your point of view specifically on...
answer the following way. Back maybe 20 years ago. Yeah.
You dropped away for a sec.
Okay. Do you hear me now?
Yes, you're back. Super.
15 years ago or so, no earnings in associated companies were present between the financial and operating earnings. Had it back then. And over time, it has kind of slipped up. And I think it has to do to some extent with the fact that the companies are trying to become more focused. They want to only, as Marietta said, work with a core business. They don't have any investment portfolios or anything. So it became quite obvious that they wanted to signal the close to the operations with this joint venture by putting the earnings into operating companies. I think, as we said earlier, it confuses more than it helps. So to put it outside operating earnings is good. Do I expect to find some non-integral earnings in associated companies? Not really. I think most of the earnings that I've seen are included in operating earnings, so that clearly gives the distinction that the companies in the future will call them integral. But I have like 12 or 13 mixed investment companies on the Stockholm Exchange, and I think they may present some companies as non-integral, but I don't think it's more than that.
Okay, thank you very much. Okay, let's move to a second point. The IASB requires either by function or by nature presentation because it would increase the consistency and comparability. We have a set of questions on this one. First of all, is a statement of profit or loss companies would be able to present operating expenses either by nature or by function based on company's assessment of which method provides more useful information to the users. So the questions are, which presentation do you prefer? Would users also expect a mixed approach to be explicitly allowed or not? When the costs are represented or presented by function in profit or loss, do you find the additional disclosure of the by nature analysis really helpful? Should an industry sector or sector select one presentation form and how to decide what is industry practice? And will the IASB proposals result in the right level of granularity? What are your views, Stefaan, on this one?
So lots of questions. First, perhaps on the natures and by function. I think, in generally, I have the tendency to say that by nature will probably give numbers that can be better used for forecasting. while I've got the impression that if it's by function, there is more an allocation decision that has to be made. An example is if you've got cost of sales and selling expenses, you can have companies having selling expenses both as part of cost of sales and recorded in the line item selling expenses. So that makes it difficult also to compare with other companies who might have other methods or might allocate differently. So there I would say I've got a tendency by nature is the better, gives more insight. On the other hand, I think it's very much related to the business of the company. Is it a heavy R&D industry or company? If not, for example, if it's a pure IT service companies, for example, there are only employee costs almost and little R&D often. Then it's quite clear. So making the decision only by the company or by management is perhaps a risk to see too much differences within one industry. And one of the purposes of this exercise is to get more comparability between different companies. If you compare different companies, it's mostly within one sector. So there should be more guidelines probably to use the same methods within the same industry only for comparison reasons. So that's some of my remarks, and I don't know if I answered all your questions, but if not, just...
Yeah, I think you did most of them, not all of them, but let's hear what Marietta has to say on this one.
Well,
Marietta,
I covered
by nature or by function. Go ahead.
Well, I cover the pharmaceutical sector, and I mean, I definitely need the expenses by function. I need to be able to distinguish between R&D and marketing spend. My dream would actually be matrix-style reporting, so starting by function and then within each function broken down by nature. But I appreciate that the cost of doing that might be prohibitive. So I'm very happy to just get the staff and material costs from the notes. But what I'm really pushing for in this context is just much more granularity on each line item, because at present, very dissimilar costs are actually being lumped together. So to give you a couple examples, on cost of goods, I would like to know how much is actual production cost and how much is it, for example, related to royalties you're paying to originators. And then I'd want some disclosures around the products that you're paying the royalty on. And if you have a U.S. listing, the SEC actually forces you to disclose some of that information outside of the primary financial statements anyway. So why not show it in the primary financial statements? And similar for SG&A, what is the actual cost of your field force and your marketing campaign? So what's the cost of actually maintaining share of voice, as opposed to, let's say, your legal expenses and your contingent consideration liability revaluations? And a big part of the reason I have always embraced the alternative performance measures is that prepare us strip out the legal expenses and the contingent consideration revaluations and the restructuring expenses and so forth. And I can actually see the direct cost of running the main business. And I know we're going to be discussing that in the next webcast. But it's just really hugely important to gauge the competitive position and to ascertain the investment needs and the cost-cutting potential in order to actually be able to do my forecast. So that's why I really mainly am looking for more disaggregation, more granularity.
Okay. I see in the meantime some questions coming up from the public as well. I take the last one here. I would like to know the reason for not requiring analysis by function in the notes when the analysis by nature is presented. I think I'm going to go back to you, Marietta, if you have any reaction on this specific question.
To be honest, it sounds to me like that question is more directed towards the IASB, because I can't really decide, what people present where. Sorry, let me just quickly look at the exact question again. So the proposal would be to to show the function in the note? Well, I mean, my understanding from preparers is that your systems are set up to either run by function. I mean, once you set it up to the full set of financials on one or the other, it's very hard to sort of reestablish what it would have been if you had presented it under the other method. So I think that's the main behind it. But that's really, I mean, that maybe some of the preparers of the IASB can really chime in on that.
Okay, then the other one that I see here, assuming that goodwill impairment is an operating expense, is it fair understanding that it is a valid line item for both presentation by nature and by function? Anybody wants to tackle this one?
Well, I hope it is. I mean, it would be strange to have an impairment test or an impairment, a write-down, being included in any other part than as an impairment. But may I just, Hans, add some to this nature or function, footnotes, or on the face of it? If I look at what I have today, more or less 80% of the companies that I look at, that I analyze, they have an income statement by function. But they are required to present the costs by nature in the footnotes, in the annual report, and that is the legislation. And I think that fits very well. The only companies that I can see have an income statement by nature is retail companies and pure like services company with a lot of employee expenses included. So in my view, function is superior if you want to, for example, analyze a company, a manufacturing company.
Hans? Nick, do you want to add something to what we just heard?
Yeah, I'm happy to. So happy to do so. So just some of those issues around by nature and by function, and in particular, why we're not asking for disclosure by function when an entity present by nature. Well, first of all, we haven't really heard demand for that. The demand from users is for additional information by nature. And secondly, our understanding is where you don't make those functional allocations already today, to ask a preparer who is presenting by nature to start to make those functional allocations would then bring in additional costs. So it's simply on a cost-benefit basis. That going that way didn't stack up. I think Marietta's right that the solution that most users would like would be the matrix. Every line is disaggregated, but that is, our understanding is that is prohibitively expensive. I think the main concern, the main frustrations users have with the mixed presentation is all of a sudden you're looking at one company that includes depreciation in its cost of sales, which generally people would expect, and then there's another situation where you have a mixed presentation and depreciation is presented separately from cost of sales, and you that incredibly frustrating.
Okay, thank you very much, Nick. Okay, shall we move to the next question then, ladies and gentlemen? And this is about the cash flow, the statement of cash flows. We have three main categories in the statement of profit and loss. I have the same names as the ones in the cash flow statements, but are not aligned, which could confuse users. The key message for investors is that the reconciliation from the P&L to the operating cash flows will have a consistent starting point, a newly defined operating profit. So is it useful, as a first question, to start a statement of cash flows in direct method with the operating profit rather than the net profit? Following up question is, does reducing the options for the classifications of interest and dividend cash flows strike the right balance between comparability and relevance? Third question, is it a problem that the new categories in the statement of profit or loss are not aligned with the statements of cash flows despite having the same names? Direct versus indirect method, both are still available. Do the analysts agree with that? Do we have as analysts a certain preference? Peter, can I start with you on this one?
Oh, yeah. I'm quite pleased with the cash flow statement that we have today. I think we have three quite clear distinctions. The first one is the operating part, that is a flow. And then you have the investing part, that is normally investing in investments in property, plant and equipment and acquisition. Then you have the third part, the financing part. And to me, that is also a choice that you can do. You can either issue shares or you can borrow money and so on. What I'm not so pleased with, and which the exposure draft addresses, is, of course, that interest costs may end up both in either in the operating section or in the financing section. So to me, it's very important that we eliminate the alternatives. I would prefer to have it all into the kind of flow section, the operating section. But if there's a demand for having, for example, interest expenses included in the financing section, I can live with that too. But I think it's important that we eliminate the alternatives in this sense.
Okay, thank you. Stefaan, your views?
And I will unmute you. Well, for me, it's most obvious clearly that cash flow statement starts from the operating profit, especially even if the different segments are not aligned with the P&L. In the exercise here on P&L, we want to start from really the operating business. So if you start from operating profit in the cash flow statement, you start from what you believe is really the flow from the business. And while if you start from net profit, you're going to see a cash flow statement adding back taxes, adding back interest, P&L interest, and then come up with the cash interest and cash taxes, etc. So making it also much more complex. So starting from the operating profit looks for me the more natural way of presenting a cash flow statement, and then going to financing. And then for me, interest income and interest charges are part of the financing cash flows. I don't see reason to separate both, because it just depends on the allocation of your gross or net debt, etc. So there, for me, that's should be in the financing. So those are for me the most important items on the cash flow statement.
Okay, thank you very much. Marietta, other views, or do you align with Stefaan or with Peter?
I completely agree with my colleagues. I would just like to share an additional practical comment on how I model cash flows as an analyst, because most analysts in industrial sectors actually start with the P&L, because the main number an analyst is expected to produce is earnings. And then, as an analyst, you consider the investment needs and the working capital requirements and so forth to run the business in the way that you're projecting it in your income statement. And that really gives you the bulk of your balance sheet. And then the final step is to build the cash flow based on the indirect method, with all of the relevant income statement and balance sheet items feeding into it more or less automatically. And that actually means that the greater the consistency between the components of the financial statements, the lower the risk of errors and confusion. So the direct method wouldn't actually work for me, because it would require me to model cash flow separately from the rest of the financial statements and then calibrate with the rest of the financial statements. And that's really a very cumbersome process that I basically just don't get paid for. I mean, analysts are just not rewarded for figuring out accounting technicalities. They're really expected to pronounce on whether a company is running a good business capable of generating cash flows, and they're under tremendous time pressure. So realistically, a lack of consistency and any scope for confusion will lead to analysts getting the numbers wrong. And when that happens, that decreases confidence in an issuer's business, even if it's a great business to begin with. So my advice to preparers would always be just keep it simple and consistent to avoid an investor panic. And that was it. Thank you.
Okay, thank you very much. Let's have a look at the questions, because we have in the meantime some questions that were relating to the different topics that we are discussing. I will start in reverse order, because the last question is specifically on the cash flow statements. Are the new categories defined in the same way as in the cash flow statement? I think we already responded to that, but does anybody want to react?
I mean, it's Marietta here. I mean, I would just say, I mean, again, this is a question for the IASB, but my understanding is that the income statement, the categories are not completely consistent across the income statement and the cash flows, but the main areas that could lead to potential confusion would be addressed. And the primary financial statements project, the main aim is really to have a lot more transparency and granularity and comparability on the income statement. And any benefits to the cash flow statements are nice to have. And I think we've had many discussions among users that really revealed that there are a lot of issues in the cash flow statements that users are struggling with. So I think that is potentially something that might need to get addressed from a broader perspective at a later stage, but I appreciate that it may not be possible to do that completely in the context of this particular project.
Perhaps I could just add, yes. So early on in the project, the board made a explicit decision, not to go down what had previously been described as a cohesiveness approach, which many of you remember was a foundation of the previous project, the financial statements project, performance project, and so not to try and line up. And we hear calls from time to time that people would like greater alignment between the three statements. But then as soon as you ask most users, does that really mean you'd like CapEx to move into operating cash flows? They then say, oh, no, I'd rather you didn't. That should be in investing. And so, again, we hear these mixed measures. I'm probably personally more aligned with Peter. I think of the investing category in the cash flow statement as the choices I have to make my investments with my cash flow, where I would see CapEx and M&A and investment in PP&E and so on. So we haven't particularly or specifically targeted cohesiveness between the three primary statements.
Okay, thank you, Nick. Okay, I move one back, and it's again on the classification by nature or by function, and it's about the FASB. Will the FASB move towards classification by nature? Classification by nature also ties well into costs to fulfill a performance obligation. Ladies and gentlemen, who wants to react?
Well, this is Peter. I cannot imagine FASB going to income statement by nature, because they have had it this way and they are into this way. So by function is definitely the best way to analyze a more complex business. If you have a simple business consisting of like 80% of the cost is raw material or employee costs, then you don't need to separate everything into production and administration and so on, because most of the employee costs will anyway become like production costs and so on. So to me, to analyze a company, to measure efficiency, to follow up on a company, and I think Marietta told us this previously too, we need an income statement by function.
Okay,
and it's Aida here, if I can just add to this. And I don't disagree with Peter at all, and just maybe to remind everyone that FASB does not have equivalence of IAS1 standard, because SEC currently sets the presentation requirements and requires presentation of items such as cost of sales. And just also to share with you that FASB have been working on a project that would look into analyzing cost of sales further, and this included the consideration of analysis by nature, but currently they put a pause on this project to allow them to progress some other work and also to see how we get on with our work here. So they might as well revisit that in the future.
Okay, thank you. I will go back one question, and we are back on the integral and non-integral associations. Is it proposed that the share of profits from integral and non-integral association, or GVs, is on a pre-tax basis? Stefaan quickly jumped on that one, but also isn't it integral to judgmental? And is this aligned to IFRS 10?
I think the separation, this is Peter, I think the separation, as Marietta said previously, It's kind of arbitrary whether you choose to have it as a non-integral or integral. And again, as I pointed out previously, what I see today are almost 100% what I would label integral associated companies. So I don't think that will be an issue normally. In some companies, yes, but not normally.
Okay.
And maybe just to add on the, sorry.
Go ahead.
Go ahead, Gabriela.
Yeah, maybe just to add on the tax, what I'm hearing from a lot of other users is that they would ideally like to get the information on a pre and post-tax basis. And so I think the question really is, could we get more disclosure around the tax implications of the associates and joint ventures? I mean, my understanding is that, the presentation on the face of the financial statements is going to be post-tax, and that's one of the reasons for separating it from all of the other operating items. I don't know if the IASB would like to add something to this.
It's Nick. I mean, I can confirm it will be post-tax. I mean, I think if there's any consideration of changing that, that will come in a research project on accounting for equity investments, which will come later. I think it's worth reminding everyone why we got here. And we got here that many companies told us that associates and joint ventures were integral to their business and actually wanted to continue to have them in operating. That was the push. And in some respects, you could argue we have struck a compromise, whether it's a good compromise or not. And the compromise was, well, actually, it doesn't help users generally to have them in operating for the reasons that have been discussed today. But actually, if you want to show that you have a set of investments in this area that's close to operating, you could show them as integral rather than non-integral. Now, actually, there's nothing to stop a preparer doing that today within our existing requirements if they felt that provided relevant information. And I've seen one French preparer do it already. I think they use the words core and non-core, in fact. But that's the genesis of it. And it was really, as much as anything, I think from a user perspective, preserve that operating number, which just reflected the consolidated main business activities, but equally to reflect that business has changed and that many of these associates and joint ventures are important to an entity's ongoing prospects.
Okay. Thank you, Nick. Two remaining questions because I see the time moving. And the first one I would like to ask is still one back. Will it still be possible to have other subtotals within the operating category, in particular with a presentation by function? Any?
This is Peter. I think if you have an income statement by function and you present today gross profit, I mean, we have the legislation within the EU and that allows you, or actually I think even forces you to present the gross profit. I think it would be kind of strange if companies could not continue doing that. However, if you have an income statement by nature presenting something that you label gross profit becomes wrong because it's not the equivalent of the gross profit in the income statement by function. So I think that must be prohibited. On the other hand, if you have an income statement by nature, you can also, to me, present EBITDA, if you like, because in that income statement, you already present on separate lines the depreciations and amortizations. Yep. So it differs.
Okay, Aida, I see a reaction. Would you like to react to this statement of Peter or of the question?
Thanks, Hans. And it's really, I mean, I think Peter explained this quite nicely, that you could present additional subtotals, but they need to fit your structure, what we call structure of the statement of financial performance and your analysis by nature or by function. So indeed, it is possible, but within these constraints. And, I think the examples Peter gave are excellent examples of what you can and cannot do as proposed in the exposure draft.
Okay, thank you. I see one remaining question, which is more a general question. What does the panel feel about the usefulness of this facelift for assessing management performance and particularly stewardship function of management?
Well, I can answer to start with, Peter here. I think it's very good to have operating profit on subsidiaries that are controlled and consolidated. And then if you have associated companies, which you by definition don't control, you have a joint venture or even less ownership than 50-50, I think it's quite clear you need to separate them from the consolidated subsidiaries. So in that sense, I think the structure is good. And in general, I'm positive to this change, definitely. It will not make that much difference in my daily work because I have more or less this separation already. But again, having the associated companies be stripped out, I think is definitely a benefit.
Okay, thank you. Any other reaction? Yeah.
Yes, this is Marietta. I agree to that, and I would just add that any additional granularity we can get helps us to assess both the operating performance, operating prospects, and also management performance and stewardship implicitly. But definitely there are other aspects of stewardship that are not directly addressed by this particular project. For example, one thing that a lot of users would like to see more of is to actually split out the performance of past acquisitions to see how the acquired companies are actually performing, to see whether it was a good acquisition, and thereby to assess the stewardship of management in spending a lot of investors' money on these acquisitions. And of course, you don't necessarily, this project doesn't necessarily force that. You can still, report a lot of operating data where you're lumping together your existing business with your legacy business with any acquired businesses. So I think this project is helpful for stewardship assessments, but there's still a lot more that I think would be required of the companies in order for investors really to be able to fully assess management stewardship.
Okay. Any other reactions on this last question? Because we are running over time. Saskia,
sorry, it's Nick again. Just very briefly, I hear what Marietta says in terms of good acquisitions, but just to remind everyone, we also have out for consultation a discussion paper on business combinations, which addresses that exact issue about the subsequent performance of acquired businesses and how best to measure that performance. So it doesn't, Marietta is absolutely right, it doesn't form part of this project, but it is an issue that's been addressed by the board all the same.
Okay, thank you very much. Thank you very much to all panel members and to the good reactions from the IASB. I will hand over back to Saskia. Thank you, Saskia.
Okay, thank you very much, Hans, for facilitating and moderating this panel and all the panelists as well. We first get Serge with his takeaways of what he heard so far in this discussion on the users, and of course he will add his own views as well, which he hasn't been able to provide so far. Serge, over to you.
Yeah, I wasn't allowed to. No, it was a lively discussion, and I started off saying this project has started off upon request from users. That's quite interesting to know. Words like more comparability, more transparency, and to avoid diversity in practice were a few of the message we got at the beginning. In general, as far as the P&L is concerned, I think in general, the people that attended the meeting were quite happy with the proposals. Operating profit is okay. I was surprised and at the same time not surprised that nobody said, let's try EBITDA. And Peter then said, well, EBIT will be okay for less operating profit. But in general, let's say the proposals as far as the P&L is concerned were well received. However, there is clearly a concern about this integral versus non-integral category of associates and joint ventures. Peter said integral, non-integral, I don't care, it's investments, so put them together. Yes, says Marietta, let's put them together, but separate disclosures on the non-integrals and on the integrals is useful information to be disclosed in the notes. She also calls for the tax effects because comparability is at stake. When you see the integral associates as part of your operating performance, if that is the right word. Integral versus non-integral, very judgmental. How will preparers deal with that distinction? So integral, non-integral, as far as I'm concerned, is not solved as yet. although ultimately Peter said to analyze the performance of an entity or the separate performances of an entity, the proposals absolutely make sense. So that's absolutely a step in the right direction. As far as by nature, by function is concerned, mixed views. I had the impression a few people supported by function presentation form, but I've heard analysts say, no, I want to by nature. So unclear what would be the best way forward there. But I recall what Stefaan said. I want comparability. So if so, it would be useful if all entities active in a certain sector would use the same presentation form. In that particular case, analysts could at least compare the way the numbers have been presented. So mixed views, and I think perhaps therefore the direction taken by IASB is perhaps the best, the most easy way to go forward. But there will be no anonymous presentation form that every entity should use. That's at least clear. As far as the cash flow statement is concerned, I would say quite some support for the proposals. Peter, Stefaan is very happy with the operating profit as starting point, and of course, the IASB had to eliminate all the alternatives that were available, that are available in IAS 7. I understand from Nick that perhaps in the coming months, years, IASB will look again at this cash flow statement and see whether other adjustments need to be made. But nonetheless, the proposals for the time being in this project on the cash flow statement were very well received. So we were quite happy with that. So in general, I'd say the reactions are quite positive, but if I then took the questions from the different parties that participate in this discussion, the questions made quite clear that there is still some way to go in connection to by function, by nature, the integral versus non-integral, the direct indirect method. So yes, we're very positive about this project, but there's still some way to go. That would be my conclusion.
Okay, thank you, Serge, for this good summary and including some of your own views that you are happy to share with the audience as well. So rest me to thank all the speakers, Nick and Aida from the IASB, Chiara from EFRAG, Hans moderating the panel, Marietta, Stefaan and Peter, and of course Serge. And to say, next meeting is next week, same time, same place, although we will be all at the same place and with the same speaker set. As said, it will discuss disclosure requirements. We will go into the topics that are very topical, like performance measurements, unusual items and the like, on which there is a lot to discuss. All the panelists are prepared to give their views, and we hope to see, not literally see, hear from you all again. So thanks a lot and see you next week.
Thank you very much.
Thank you.
Bye.
Have a good evening.
Have a good evening.
Bye-bye.
Thank you. Goodbye.